Are we in for another September swoon for stocks? A post-summer pullback? An autumn acquittal? September is historically the worst month for stock market returns. Will history repeat itself? Stay tuned to find out where I think the market is headed and the information to back it up. Since 1928, the month of September has generated an average stock return of negative 0.1%. Okay, not huge downside, but that's an average. That masks some rather large pullbacks. It's more bearish at a full point pullback during the last 20 years. The best months for stocks tend to be the turn of the year or summer months, but that point is moot until we get there. Back to September. Since the market has been on an epic bull run and valuations are at all-time highs, pundits have been calling for a correction for months now. Last August set records, closing at all-time highs 12 separate times. These were led by financials, travel, and technology. So why hasn't a crash or pullback happened yet? Well, we've had loads of stimulus, trillions in excess cash sloshing around the market, and optimism regarding the latest statements from Jerome Powell and FOMC. Even now, especially in September, the chorus call for a correction is even louder. But it's not for some epic COVID crash, some great recession, or even the next Great Depression. It's for something more moderate, and I'd argue something healthy for the market. A correction of 5 to 8% would tamp down some of the unbridled bullishness and bring valuations closer to in line with historic norms. It would also allow some of us investors that have a little dry powder on the sidelines to push more capital in on a moderate correction. I've got a video coming out next week talking about how much cash to keep on the sidelines and how to know when to deploy it. Hit that subscribe and bell to receive notifications when that one comes out. Okay, so we have pundits saying a market correction is imminent. History shows us that chances for a correction are higher in September. But, and here's the big but with a capital B, this rally is unprecedented and is bucking all trends. The S&P 500 has hit all-time highs 53 times this year alone. The market is largely detached from fundamentals and historic multiples, and many times it has moved well outside its moving average and technical indicators. So what are traders doing? What are portfolio managers doing? Well, they are having their cake and they're eating it too. We've seen some profit taking on high-flying tech stocks. We've seen a moderate rotation into value stocks, and honestly, fleeing some riskier plays like Chinese stocks and Chinese tech stocks. These are all pretty common practices near a market top, but by and large, managers are maintaining their bullish, high growth positions. And here's how they're keeping their cake and eating it too. Puts protective options that allow them to maintain their positions but hedge some downside risk in case there is a sharp pullback. I'm not personally pulling the trigger on any puts, but I am taking some profits and holding a bit more cash in case there is a correction. So what to watch for? COVID and especially the Delta variant. Look at specific geographies like India and the South in the US for leading indicators on how that variant will run its course. Obviously, keep a pulse on market sentiment. Right now, I'd broadly term the market as hesitantly bullish. Many think this upward trend will continue, even if we see a moderate pullback in the near term. But most importantly, watch the Fed. Mark this date on your calendar, September 22nd. That is the committee's next meeting, and expect the market to hang on their every word. That date will very likely be a catalyst to determine if this rally will sustain or if we're in for a bumpy ride. I'm curious if you think we're due for a correction. If so, what are you doing to protect your portfolio? Let me know in the comments down below. Thanks for joining, and I'll see you on the next one.